Separable mean that you could like trade it separately. You know its value like the through a reliable resource, and you could trade it separately. So this is the like definition. If something comes on the intangible asset, so you should be able to define that what actually intangible asset is, and then then how we could like categorize it as any asset as an intangible asset. So for any asset to qualify it as an intangible asset, it would have to meet certain conditions. So those conditions are that it should be separable and it should arise from a contractual or other legal rights. Um, we have learned that intangible assets, if internally generated like a goodwill, this should not be recognized because those are not identifiable and not capable of reliable measurement, because those when you would be uh, generating the goodwill internally, obviously the value of that goodwill would be reflected in your share value if your company is listed, and if your company is not listed, then it would be like being reflected in its overall value of the company. If you ever would like be evaluating the worth of the company, then this value might have been reflected in the total value of the company. Then if intangible are internally generated, intangible assets are generated, it could be goodwill, and the others, if it's not goodwill, then the others recognize at a cost if recognition criteria is met. But you should know that the recognition criteria is that it is separable, it is measurable, reliably measurable, and it is identifiable, right? So this is the criteria. You should like memorize these 2-3 conditions associated with the intangible assets, because there are chances that you would see something in the exam which could like ask you about this concept. And then if intangible assets are purchased, then um, we would see that if those assets are being purchased separately, then we would record at a cost if recognition criteria met. Again, this is an important prerequisite for recognizing any intangible asset, that it should meet the criteria which has been defined, like it should uh, it should be identifiable and it should be separable and capable of reliable measurement, right? So if an intangible is purchased as a part of a business combination, then uh, we should record and fair value assuming it's like we should record at fair value assuming asset is identifiable and fair value is reliable, right? Otherwise included in the goodwill. If it is not separable, then intangible asset would become a part of the goodwill. We would not be recognizing it as a intangible asset, right? And you know that goodwill is a non-current asset which we recognized in our balance sheet. Somebody is recording it or not? Okay, great.
जी सर.
So, great. Okay. So now, intangible assets, when we talk about the intangible asset in scenario of trainer course is designed and created by trainer cannot be recognized as intangible asset. So, Babar, would you tell me that why we cannot recognize those intangible asset? I mean, the courses which are being generated, uh, designed, and then created by the trainer.
सर फर्स्ट ऑफ ऑल ये तो इनके पास इनके कॉपीराइट्स भी नहीं है ट्रेनर के पास. और सेकंडली इन हाउस डेवलप्ड एसेट्स हैं, वो ट्रेनिंग कोर्सेज हैं.
Okay. Waleed, do you have any idea that why won't be recognizing uh, those courses as a intangible assets?
सर एक तो जो पहली बात हमने की कि जो गिवन इंफॉर्मेशन है उसमें वो प्रॉपर्टी ट्रेनर एज ए ऑर्गेनाइजेशन ट्रेनर की नहीं है, बल्कि जो ट्रेनर हम हायर करते हैं और वो उस कोर्स को डेवलप करता है वो उसकी ऑनरशिप है। और अगर नेक्स्ट टाइम वो ट्रेनर नहीं होगा तो वो कोर्स कंटेंट भी हम नहीं यूज कर रहे होंगे। तो
हाँ
और जो
हाँ।
सेकंड एग्जांपल ये दे रहे थे वो शायद रेलेवेंट नहीं है, क्योंकि ये गुड वो जो इंटरनली जनरेटेड होता है वो प्योरली इज फॉर गुडविल। अदरवाइज अगर हम कोई इंटरनली सॉफ्टवेयर वगैरह डेवलप कर रहे हैं या कुछ भी कर रहे हैं हम उसको रिकग्नाइज तो करेंगे। वो सिर्फ स्पेसिफिकली गुडविल के लिए होता है कि इंटरनली जनरेटेड गुडविल को हम रिकग्नाइज नहीं करते हैं एज एन एसेट।
ओके।
यहाँ पे इशू वही ऑनरशिप का है, राइट्स एंड ऑब्लिगेशंस वाली बात आ जाती है।
And then the criteria, that I'll go take you back to the internally generated asset. The internally generated intangibles are goodwill, should not be recognized, not identifiable, not capable of reliable measurement, right? So this is like now, any intangible asset which is not separable, which is not identifiable, which cannot be measured reliably, would be counted in the goodwill, and the others recognized at cost if recognized criteria met. Can the value of the courses which trainer is currently designing and delivering to its clients, can we measure its value reliably? We don't have any, because those are not being traded in the market, those are not being sold in the market. So from the given information we don't know that can we assess the value of those courses reliably. And then identifiable, yes, it is identifiable, the course content is created by the trainer. But if that the training course is the property of the trainer, no, it is not the property of the trainer, because those specialized materials are created by the trainers which trainer hire. And those courses are purely, I mean, belong to the trainers, because it has been given in the pre-scene that if the trainer would stop getting the services of a trainer, they would also stop, teaching a specific course designed by that trainer. So you cannot like recognize that course as an intangible asset. Then the cost incurred to create courses internally should be expensed out. That cost is already being reflected in the total amount or the remuneration which is being paid to the trainers. So that is already being expensed out in the profit and loss statement of the trainer, which we have seen in the financial information of the trainer. If those courses are purchased and the value of such courses could be measured reliably, then should be recognized separately in non-current assets. And if the purchased courses would be having a finite life, then we would amortize them, right, Usman? And if the life of such purchased courses is infinite, then it would be tested for the impairment, right? So these are the important concept. Even if
So
you if it is not like given clearly in the unseen, but you should have the capability to like segregate and address these ideas. Yes, Waleed.
इसमें बेसिकली एक सिनेरियो ये भी हो सकता है अनसीन में कि ट्रेनर अपनी पॉलिसी फॉर एग्जांपल चेंज करता है और वो उस पॉलिसी पे चले जाते हैं कि जो ट्रेनिंग कंटेंट होगा वो ट्रेनर ऑन करेगा। इन दैट केस इट्स वेरी मच पॉसिबल कि फर्स्ट टाइम जब हम किसी भी ट्रेनर को हायर करें तो उसकी रेम्यूनरेशन को हम इस चीज
सेग्रीगेट
भी
कर लें।
सेग्रीगेट कर रहे हो कि कितना अमाउंट कोर्स कंटेंट क्रिएशन के लिए है और कितना जो है वो कंटेंट की
एग्जैक्टली।
डिलीवरी के लिए है। तो फिर हमारे पास वो मेजरमेंट क्राइटेरिया भी आ जाएगा
then
कि किस अमाउंट को हमने कैपिटलाइज करना है।
then these two bullet points would get into action. You would recognize, right, then your intangible asset, and then you would amortize, or you would test that intangible asset for its value, like the impairment.
Impairment.
You will test it for impairment every year. Now, this concept should be very clear to you because this is so relevant to your case study, Haris, right? So the basics of these all the basics are coming from the pre-scene that we have studied. So you should know that what is the current business model of the trainer and how they are, I mean, dealing with their content currently, right? So then the next topic that I wanted to share with you today is the fund subsidiaries, because currently from the pre-scene we know that there are three fund subsidiaries which are fully owned by the trainer, and those all three fund subsidiaries are operating in the other countries, right? So, in order to understand the issues or the matters around these foreign subsidiaries, we need to have the prerequisite knowledge of the functional currency and the presentation currency. So, the functional currency, I'm just recapping what you have already studied in your F2. Functional currency is the currency of the primary economic environment in which the entity operates. Currency that mainly influence the sales price of the goods and services. Currency of the country whose competitive forces and regulations mainly determine the sales prices of the goods and services. And then currency that mainly influence the labor, material, and other costs of providing the goods and services. So actually the idea is the currency which would be influencing your operating cost and your revenues would be considered as your functional currency. And I believe that we had already done a assignment on it, so it should be clear to all of you that you have seen that assignment. I have given you a feedback on that assignment, so probably you are quite comfortable with these concepts. And if you still have any issue, you should read it in more detail in your book, right? And then the presentation currency is the currency in which entity presents its financial statements. So now the subsidiaries, all of our three subsidiaries, they would be having their own functional currency. But when we would be like consolidating those subsidiaries into the group accounts of the trainer, we would translate those accounts into the presentation currency of the trainer. So Trainer has three fully owned subsidiaries, and their functional currencies must be different from that of Trainer. So financial statement of these subsidiaries must be translated to presentation currency of Trainer, right? So the start statement of the profit and loss and other comprehensive income, those would be translated um, at an average rate, uh, I mean the currency rate. As we know that the statement of profit and loss represent the performance over the period, right? So in order to translate the subsidiaries in their true sense, we would have to apply the average rate. But for the statement of the financial position, we would be translating the subsidiaries account into like using the closing rate, because the statement of financial position or the balance sheet tells you the condition or the status of a company on a given date, right? So we know that when we would be translating those accounts of the subsidiaries, there would be certain exchange difference. So upon translation, there could be exchange difference which can be separated into two components. And the one was the exchange difference on the net assets, and the other was the exchange difference on the goodwill. Now, these both concepts have been taught you. I don't know which was the chapter number, but uh, I hope that you remember that those two concepts were taught you like in detail. So, exchange difference arising from uh, retranslation, retranslating subsidiaries will be recognized within the other comprehensive income. Now you need to learn the details of these two exchange differences. If you already have the idea of these two concepts, very good. If you don't have the idea, please go back to the book and read those the concepts again. We have already learned about these concepts, so I'm not going to get into the details of these two components of the exchange difference which could arise while you would be translating the financial statements of your subsidiaries before consolidation to the parent or to the group account. So trainer now the another important concept is that if the trainer would be acquiring another company, right? So trainers and the acquired company's assets and liabilities, income and expenses will be combined in full. We know that while we would be acquiring a company, we would be consolidating its account into our account. So we will be line by line balance sheet and income statement would be consolidated. Goodwill will be recognized in accordance to the IFRS 3 business combination. That has already been explained to you in detail. That's why I was telling you that you need to remember these concepts. uh, if you have any confusion about this concept, again you could go back and see that concept, that how you would be recognizing the goodwill. We have studied that how you would be attributing the goodwill portion to the parent and to the non-controlling interest, right? And then share capital of the trainer will be the share capital of the group, right? And intergroup balance and transaction, if any, will be eliminated in full, and non-controlling interest will be presented within the equity, because those non-controlling interest shows the ownership part of the company, so those would be presented in the equity. You should be very clear that the non-controlling interest is also a part of the ownership of the company, so that would be reflected into the equity section of your balance sheet, and that would be separate from the equity of the owners of the parent company, right? So these would be the a few concepts you will have to address if you get anything on acquisition. And then valuation of NCI at acquisition. We know that there are two methods to value uh, the NCI. One is a fair value, and the other one was the proportionate share of the net asset method. So a quick recap is that fair value of NCI is calculated at market value. So when we would be recognizing the value of the NCI at the market value, we would be recognizing the goodwill part of the NCI as well, because we know that the share value of the company represent the goodwill part of the company too. So
सर मेरा
when yes, please.
ये ट्रेनर के केस में तो एनसीआई का सवाल ही नहीं पैदा होता, बिकॉज ये तो फुली ओन्ड सब्सिडरी है, मतलब सारी फुली ओन्ड है, 100%
नहीं,
शेयर होल्डिंग ट्रेनर की है.
नहीं, this is not about like the current subsidies. This is about if the trainer would be acquiring another company. These concepts you will have to
हाँ हाँ
address
सही है
these
सही है.
concepts if trainer would go for the acquisition of another company, and that then the NCI concept would involve only if NCI would be going to acquire that company partially, not the complete 100%. If it would be acquiring the 100% of the other company, then the concept of the NCI would not be relevant. You got me? Like if in question you see something that a trainer is going to acquire another company 100%, then you should not address these topics, right? This would be applicable only if trainer acquire another company,
सही.
like the 70% of the other company and the 30% is the NCI. Then you need to address that topic under these guidelines. Then if you would be evaluating or value we would doing if you would be doing the valuation of the NCI at the proportionate share of the net asset method, we have seen that we have discussed it already, while this method of assessing the value of NCI doesn't take into account the goodwill portion of the in the company, because this is based uh, on the net assets of the company. So we would not be recognizing the goodwill part of the company, and we would not be attributing that goodwill part of the company to the NCI. The goodwill will be goodwill part of the acquired company would be attributed completely to the parent. So from these two concepts, when we are when we are familiar that which method has been used to for the valuation of the NCA, then we would be attributing the impairment loss in accordance to these two methods. Like if we have if we have valued the NCI using the fair value method, then what we will do is that we will reduce the goodwill by the full amount of the impairment loss, right? And because you know that goodwill is tested for the impairment at each reporting date, and in case of any impairment loss, that loss would have to be recognized. And if we do have the NCI in our NCI shareholding in our subsidiary, then we will have to attribute the impairment loss to the parent and NCI in accordance to the method through which the value of the NCI has been recognized. So we will reduce the NCI equity by the NCI percentage of the impairment. Why we would be doing that? I had already discussed that, because when we are recognizing the goodwill value for the NCI, then obviously it will have to take a share from the impairment loss of the goodwill as well, right? And then we would be reducing the consolidated retained earnings by the parent's percentage of the impairment loss, right? So you would be reducing the retained earnings. And proportionate share of net asset method. In proportionate share of net asset method, we have already learned that in this method of recognizing the value of the NCI, we would not be recognizing the goodwill value for the NCI. Therefore, we would not be attributing any impairment loss to the NCI. So the whole impairment loss would be attributed to the parent share. So that would be reflected by reducing the retained earnings of the parent, because the retained earnings belongs to the parent company, right? So now these were the the remaining three concepts